Recap of the economic news of these last weeks. USA, funding rate, February 1st, up 4.25%, 0.25 bits per second increase as expected. Unemployment rate, February 3rd, at 3.4%, lower than expected by 0.2. Europe, the funding rate is up 0.5 basis points to 3%, as expected, February 2nd. Unemployment rate, February 1st, 6.6% unemployment rate. China, the unemployment rate, January 17th smiley face, was 5.5%, down 0.25 bits per second. GDP growth rate, 2.9% actual GDP rate. Inflation rate grow to 1.8% annually. Russia, inflation rate, 11.9% of inflation, January 13th. Some exciting news upcoming.
U.S. regulators are to ban crypto staking services for retail customers. The consequences for the crypto industry could range from reducing retail holders' ability to exchange coins for the dollar to crypto exchanges closing operations in the U.S. market and a lack of access to financial innovation. Nick Carter, the co-founder of venture firm Castle Island, believes this move would lead the crypto industry to return to the bad old days of 2014 to 16 when it was difficult to get funds on exchanges. Aaron Kaplan, the co-CEO of blockchain fintech Prometheum, believes that the crypto financial services ecosystem is evolving to come in line with established regulatory frameworks. In contrast, Carter predicts that the initiatives will be unproductive for the industry and retail investors, empowering shadow banks and delaying their development in the country. The Securities and Exchange Commission, SEC, and the Commodities Futures Trading Commission took notice and decided to take a stricter approach to the industry. Their focus shifted towards fiat on-ramps via U.S. banks and eventually staking, which involves holding onto crypto assets for a certain period of time to earn rewards. The CEO of centralized exchange Coinbase, Brian Armstrong, hinted that the SEC wants to eliminate staking for retail customers in the U.S. This led Kraken, one of the leading crypto exchanges, to shut down its staking as a service program and pay a hefty fine of $30 million. The trend of stricter regulations is set to continue, with a possible ban on staking being imposed on all U.S.-based companies. The United States authorities are attempting to isolate the traditional financial system from the crypto market, according to sources. The alleged strategy involves multiple agencies discouraging banks from dealing with crypto firms with the goal of leading crypto businesses to become completely unbanked. The regulators are reportedly threatening and bullying bank leaders behind the scenes, then publishing public guidance that banks are free to custody crypto or service crypto clients, but in reality, they are not. The joint statement released by the Fed, FDIC, and the Office of the Comptroller of the Currency warns of the risks of banks engaging in crypto and encourages them to refrain from doing so due to safety and soundness concerns. The chair of the United States Securities and Exchange Commission, SEC, Gary Gensler, has warned crypto companies to follow the law and register with the SEC. During an appearance on CNBC's Squawk Box, Gensler claimed that many crypto companies were choosing not to comply with regulations, adding that the business models of many crypto projects had conflicts that needed to be addressed. He emphasized the importance of time-tested rules and laws to protect investors, stating that companies should not misuse customer funds for their own platforms. Gensler's statement came after the SEC reached a settlement with crypto exchange Kraken, which involved shutting down its staking services and programs for U.S. customers, as well as paying a $30 million settlement in disgorgement, prejudgment interest, and civil penalties. However, the settlement has received criticism from the crypto community, with SEC Commissioner Hester Peirce calling the actions lazy and paternalistic.